Hello friends, my name is Anshul and welcome to another of our webinar. Today I have with me Mr. Gunit Singh. He is the founder of Finegriti Capital, and we'll be in conversation with him today. We'll pick his brains on mutual funds, investing, and whatever a new investor has running through his mind. So welcome Gunit. Thanks for coming here.
Thanks so much.
So let's start with the basic. I think a lot of our customers, a lot of our clients, investors who use the Groww platform, one of the typical queries they probably have in their mind is, how does a mutual fund work? What is the life cycle of a mutual fund? Where does it start? What goes on inside a mutual fund? Who are the people involved? How the money actually goes in and comes out? Probably you could help us understand that.
I think overall it's kind of a factory which starts from money moving in and then takes you to the whole cycle, and the ending happens when the money moves back into your account. So I would focus on what is more relevant to the investor in terms of money reaching the market and what is the journey post that, because apart from that, more is operational part. So prior to even money moving in, there are certain due diligence done on the stocks. So there is a kind of a sample of a baskets, which could be, let's say, 100 in number, which are allocated as far as on the mutual fund piece by the overall fund management team headed by the CIO. This I'm focusing on the equity part. Now, whether it's a large cap fund, a multi-cap fund, or a small cap fund, basically they're supposed to pick up the piece from this basket. If a fund manager has a certain view of something new to be added, there are focused analysts which would either oppose or accept it, and once it is presented to the committee, then only it moves back into the basket. So this creates a kind of a strict control in terms of processes, and to make sure that the things are not emotionally driven and are more following an investment process, which kind of gives a comfort level to the investors. Second, what we have to keep in mind that mutual fund industry, the whole appraisal of the fund managers is linked to how much they beat the benchmark. That is, it is an alpha-driven industry. What you do above that is something which is taken as an excellence point, but your basic ideology works in that how much you can beat the benchmark. And this is how their whole remuneration, everything is linked to, and the legacy which they build during the course of time of their fund management career. This again puts in the genesis of the mutual fund industry, which is charging a certain management fees. Otherwise, an investor can basically just buy the index. No charge, moves into, opens a demat account, buys the index, and remains on that equity asset class. So what is mutual fund doing to him? He's saying that I would outperform the benchmark. Now this is where the starting point comes in. In the last 2 decades, or I think 25 years of the private sector moving into mutual funds, average outperformance of these benchmarks are on a very, very high level. Which average it could work on a multi-cap portfolio in the range of around 10 to 12% CAGR by the top quartile mutual fund provider. Which basically puts into perspective that on an average, most of these multi-cap portfolios have generated, as of the last month end, to tune of 20 to 22% per year for last 25 years. And this number is a little to keep in mind, that basically these guys are doubling your money every 4 years. And there is basically a legend in this piece that we keep cribbing about the market, short-term performance, whatever in the current scenario. But the analogy here is that Innova from your home is daily going to the airport, Bangalore airport. It's a tough call reaching there with the traffic, but it is really going there and dropping the people who have been part of this Innova. which is a journey from X to a 22% CAGR for last 25 years. It is your problem if you exit before reaching the airport. So they are doing their job. You would have to figure out that during this period of time when he's stuck in the traffic, or there are signals which are not working and you are paranoid or you are concerned that whether I would reach there on time or not. But the point is, he's reaching. It's up to you to make sure that you remain as part of it. Use advisory portfolios, online portfolios like Groww, and make sure that you remain stable. Because if you're convinced that the Indian economy, for various reasons, if it is able to create certain kind of return, then mutual fund is one strong tool to participate on. Point one. Point two is, this also highlights the point that whether they are able to do justice to their management fees or not, which is this vis-a-vis the ETF, which are low expenses, and in the developed economies like US and all, the ETFs and expenses are becoming very, very prominent. The genesis in the Indian mutual fund industry, and that's why various participants are moving into it, is that till the time you're able to create alpha to the extent that you're creating, management fees is here to stay. Because the investor is more concerned whether he's making the returns or not. He doesn't get into the thing whether someone is charging him 1.25 or 1.75 or 1%, as long as he's making those kind of returns.
So the next question that I think most people, and especially what's going on recently, the way markets have been extremely volatile in last a week or so. A typical know-nothing investor or a new investor, whenever he starts investing in the market, either direct or through mutual funds, whenever he sees these kind of ups and downs in the market, it comes like a shock, right?
True. Very true.
Right, and especially when we hear news in the media about market tanking by so many points, and other macro stuff talk about crude oil price rising, interest rates rising. Most people don't really understand what it means, but they surely get scared out of it. So what do you think is the right way for a new investor to should he just close his ears and not listen to all the news, or should it affect his investor behavior? Should it pull out his money? All this actions driven out of fear. How do you deal with it as somebody who's been in the market for so long? How do you deal with it, and what advice do you have for an investor to deal with this kind of news which affects the market performance? And does it really matter in the long term?
We call it the behavioral part of investment, and as you rightly said, if he can cut his hearing capabilities or viewing capabilities, it's done. But unfortunately, we all are human, and if you look at from their perspective, it can get very tricky. Actually, the whole genesis of the investment advisory business lies on this particular point. That how do we protect the person from himself? And this is where I think role of platforms like Groww or other advisory platform comes into play. Is it how can you make him understand that the job is of a professional? Just like anything, whether it's a medical profession, whether it's a legal profession, whether it's an accounting profession. Fortunately, in a medical profession, the guy doesn't go into the other side of the table and say, okay, this heart looks papering stuff, or goes and does the analysis, then no, I can handle it directly. While in this business, everyone has a viewpoint, and then of course the media. There was this good anecdote between Warren Buffett and Bill Gates. I think he was doing some convention in Stanford or Harvard, and he said that, my friend Bill, no one says that they can do what Bill Gates can do. But 95% of the audience feel that they can do what I do. So, which is a kind of a genesis of the piece, that everyone feels that they can short a DHFL in the current scenario, or they could have easily bought Bajaj Finance 4 years earlier. But the key is that kind of play is transactional. And once you are in that loop, you would never be able to make meaningful wealth. The key here, and why mutual fund came into picture, was that you had one professional life which was creating cash flow for you. It could have been anything. Your business, you being doctor, you being legal guy, a simple salaried person, is creating a cash flow for you. It is also creating some incremental cash flow to you, which you're not using. That money has to move somewhere. The potential of that other money is so high, which we call the second earning, that's where the vehicle like mutual fund come into play. That ideally, if it happens in a disciplined manner, that cash flow moving into as a second earning has the potential to match this cash flow. A salaried person, he would do anything and everything to make sure that his appraisal get that 15%. But he's comfortable for his second earning to be there in a saving account at 3.5%. Or move around in ULIPs and the other stuff, or fixed deposits without any concern at all. Now, this particular product basically says that if you follow that financial planning rule, with a simple asset allocation with 2 points stuff, anything which is above 3 to 5 years move into equity asset class, anything which is required less moves into a liquid category fund. Again, I would repeat, platforms like yours are basically supposed to create that, and you're doing a job on it. Now, what is the rocket science in this? In this, what can go wrong? So let's say there are 44 AMCs and 25% are in the top quartile, and you find platform like yours or whatever advisor, about 3-year money moves into this stuff, and the other 3-year money remains here. The top end of the product might be giving 20, 22 and 25 years, and the worst might be giving 15, 16. Of course, you would be somewhere on the median, so you would not choose something which would give you a negative return of 8% because your shelf life for these products are very high. So there's no rocket science into this category. Now, what it is detaching you from is the buzz, is the fee. You cannot talk about it because there's nothing to talk about on this. You have given it, outsourced it, someone is managing it, giving you, doubling your money every 5 years. There's no sex appeal in this. There's no flamboyance in this. Enter a trading platform, looking at CNBC, Economic Times, talking to your friends in James XYZ, getting the pulse, buying something, making some 3-4% return in one day itself. Now this gives you that sense of euphoria. If you want entertainment, they don't give you entertainment, they give you pure money. So you would have to detach yourself because everyone needs entertainment. So then take a pocket money of 10% of that thing and create your entertainment. Let the 90% of the second earning remain there. But here we're talking about serious wealth. We're talking about financial independence, which basically means that during the course of time, you can continue to do professionally whatever you want to do, but you don't do it because you need money. That is the whole genesis of the wealth management business in a very, very ideal scenario.
So,
which basically puts into perspective that whatever is happening in a last month time or 2 months time, or what is happening to the crude, what is happening to forex is irrelevant to you. There is nothing which is happening in last 2 months which has not happened in the last 25 years. Actually, of a magnitude of 10x has happened, but still 30th September closing, a plain vanilla index has generated 15% in last 365 days, which is 1 year. And while we're talking, it has generated 8.67% return. And we're talking about market crash. Do I have a control whether Mr. Modi wins the election? I don't know. Do I have a control that whether those 3 or 4 state elections BJP would win? I don't know. If BJP doesn't win, would it affect in short term the market? The answer is yes. Do you have a control on that? Would an emerging market guy stop investing? Sorry, a developed market guy stop investing in a 7% GDP market and continue to invest in 1 or 2% GDP market? If you are then, what would you do? So how does that matter? And that is the job of a fund manager. You have outsourced him at an X percentage. So let it be. And as I told you, 10% is your pocket money. Entertain yourself with it. So the loss still remains, loss or profit remains there. And it doesn't meaningfully affect your wealth generating tools. That's it.
So it reminds me of, I read somewhere that people talk about HDFC fund. Prashant Jain has given 25% CAGR in last 25 years. But very few people realize, as you said, going from home to the airport, how many number of investors in that fund have stuck, remain invested right from 1993 today to claim that I have also generated the same returns. Very few. I think the figure was 2% or something like that.
Exactly.
Only 2% of the investors stayed. Yes. So that's why sometimes when you talk about the fund performance is necessarily not equal to investors' performance because they dance in and out of the fund, right? So that brings me to another important question. So when you talk about these, star fund managers like Prashant Jain, of course he has been. You can't just say that he's lucky. He's definitely very skillful. But again, looking at him and judging his performance, there is a lot of hindsight bias in that, right? So today, when an investor wants to start, the first decision he has to make. So once he has chosen few funds and he starts his SIP and outsources these things to automated platform like Groww, it's kind of taken care of. But to take the first decision, let's say to choose 4-5 funds, the first decision he has to take is to select those funds. And as they say in financial industry, right, the past performance is not the guarantee of the future returns. So I could look at a fund which has done great performance in the last 10 years, but at the same time, future is not the same as the past. So looking only at the past performance is not the only criteria. But according to you, what else an investor should look for to increase the possibility that the basket of funds which he is choosing is odds are high that they'll outperform, or maybe they will meet his investment criteria, or they'll outperform the inflation at least. Right. So what criteria do you think they should look for?
Exactly. So I think this is a very, very valid point. I think I demeaned the whole investment advisory industry in the earlier question, because to me, if I'm from that industry, I understand the thing, it becomes very simple. But if you look at from an investor's perspective and look at all the people who are trying to peddle the product, it can become very tricky, especially when the trust capital is very low. So I think you have a very valid point, and that I think where the importance of platform like Groww comes into play. Kitne mein liya becomes quite a critical point. In a more reformed manner, we call it valuation. It depends how much are you clued on in terms of understanding. There could be investor who's reading or viewing or talking. If he understands at least that an FMCG platform, FMCG category currently is overvalued, and a corporate bank, industrial goods are currently undervalued. This is one category of investor. We call them informed investor in terms of category understanding. Then comes the common sense piece that what is overvalued should not be bought, which basically means that returns of which category would be high? An overvalued category, which would be showing a negative return, an undervalued category. Anything which is undervalued is not necessary that it is good, but from a perspective, we call it future earning estimates. Again, this could get a little jargonic, but in a more simplistic manner, undervalued, overvalued, you avoid overvalued and invest into undervalued. So in a current scenario, if you're starting afresh, what would the portfolio be made of? Portfolio currently would be made of, in a chosen sector, which would be a corporate bank, industrial capital goods, a defensive move of IT. Can you do that? Chances looks remote. So what do? You buy a basket, and the basket is saying what? It's calling itself a multi-cap basket. Now what a multi-cap does is, whatever we discussed currently, is that it shuns the overvalued, that is its job, and buys the undervalued, and then picks up certain defensive and clubs it together. Then comes the question of large cap, mid cap, small cap, which you keep hearing, and that is what multi-cap is about. That in case the small cap is overvalued, so he reduces the percentage of small cap and picks up the undervalued one, which currently are looking like large cap, and he does the reverse when the scenario changes. When you do your plus and minus, which is buy and sell, you pay tax. These are pass-through vehicles, which basically means that when they do their buy and sell, there's no tax outflow from your pocket, and neither from their pocket, because they are representing you, and that is their job. Your job is to choose the basket. It cannot get simpler than this. Again, it comes to the same play. It doesn't have the sex appeal. Because you might be hearing some news, but you would not come to know much about it. You would be aware of the portfolios, you would be aware of the price, but you are seeing a beach from a distant door. When you open the window, you might see the sound, but still you cannot get the feel. So you would have to let go of the entertainment piece. And other than that, the whole thing, which I tried to discuss in the first part, and even while I was speaking, it was becoming complicated. So think about it, when you would be doing it, what would happen? And that's where the basket come into play. So let me move to the step 2. We decided, let's say, because of this category, we move on to multi-cap on the equity asset allocation piece. Now how do we choose these multi-caps? We're trying to create a flowchart way for a person. We create category of funds which have run cycles of investments. On an average, in last 25 years, around 6 cycles have come into play, which basically means you use the word that he might have been lucky. So you might be lucky once, you might be lucky twice. Doesn't happen, but you might be lucky twice. But if you're able to maintain through 6 cycles, we don't call that luck. We call it very, very high degree of experience play. It doesn't mean that he would be lucky in the next 6 months, but basically you give him time and he has proved that he manages the play. It happens with a lag, but it happens. And that's why if you look at it, everyone keeps talking about 3 years, 3 years plus, 3 years plus time. There's a logic behind that, that kind of aligns when you've taken the call. So you build a sample size out of that, I think 4,500 schemes, and you would end up with some 10 to 15 schemes. In that 10 to 15 thing, you create a platform of these 10 years, and you would find 3 or 4 schemes. Again, that's where the investment platforms come into play. But what they're saying is, we have the data, you ask the relevant questions. Because let's face it, with Google around, there's no issue of data. It is more about asking the relevant questions. Visual advisor or do-it-yourself concept, whichever way it works for you. You are going to be the master of that decision. But the step are on these two tabs. Then there are comparatively more aggressive investors who have gone ahead on this life, and then they feel I can take sector bets, I can take market caps bets. That I genuinely believe, let's say 3 years earlier, if we were talking, that yeah, small cap is making more sense for me and I would allocate X percentage to that. Or let's say pharma is making more sense, or infra is making more sense, or banking is making more sense, and then they take these bets or baskets. And these are more informed investors. Otherwise, it is pretty simple. On the equity side, you pick up a multi-cap book, and on the debt side, you pick up a liquid plus book, and you're good to go.
So,
the third point, sorry to interrupt. Then comes the concept of SIP, since we were talking about from a salaried investor point of view. Now you have to keep in mind that SIP came into existence with people. I'm talking from an investor perspective, and then I would cover the manufacturing perspective. Housing business was going phenomenally strong with the advent of HDFC Limited, and when he broke the asset and say that you can pay it on a monthly basis on a very aggressive manner. It basically puts into picture that this is a large asset. I create a platform for you and you pay me monthly, and that is securitized towards me, which generated a phenomenal alpha towards that industry, that everyone had this thing that I want to buy a house. SIP came into picture as an investment of this particular asset only, saying that you are not able to enforce discipline on yourself. So we would create an investment plan for you where you can cut a monthly check, and which worked very well because it enforced a sense of discipline. That was first. Second, it removed the issue with time, which was a major problem, and it gave you sense of average. As of last month, I think we were talking about some 7,200 rupees of SIP coming into play. This is a perspective from an investor. What no one talks about is that this is a major advantage to the fund manager as well, and to his alpha making capabilities. You are giving those top quartile schemes an average of around 7,000 crore every month in some various dates or weeks. Market changes every day. He's telling you to keep the money for 3 years. His analysts and this stuff have a buy and a sell target. He's not saying that if it reaches a sell target in a month's time, he won't sell. He would. And the same goes for buying also. There's a legend on one of the core fund manager who has been the most talked about in terms of long-term investments and the largest SIP thing, that he has sold stocks in 30 minutes also. And someone asked him, you keep talking about long-term. He said the sell target was over in 30 minutes. So they are not, mutual fund is not about passive investment from a fund manager perspective. He is supposed to be on the job day in, day out. That is what he does. That is how he gets paid. This long-term perspective is for you, that whatever the volatility comes during the play, you are able to pay through that, and SIP is it too. Now consider this, that you are giving him 7,000 worth of money every month. For him, it's a major plus point, because these buying and selling targets keeps changing, and especially in these kind of downward markets, he's able to buy quality stuff on your behalf. So it's a win-win situation for both industry, the investor, including the advisor. who's making money out of your money as well, for him it is coming on a monthly basis, so he can plan his business ahead. And that's why. So SIP basically evolved the industry to a different line as such, and not at the cost of the end result. It basically enhanced the end result, the user experience to a different level, and it continues to do so. As you can see that now they are comparing this piece to the contribution of the FPI, which I think is a major confirmation of the Indian investors contributing to the equity asset class.
So now that we are talking about SIP, one interesting question that one of our viewer in our last webinar asked us is, okay, so my SIPs are running, right? And I understand that I can comfortably, as my salary increases, as my income increases, I can slowly, gradually increase them. But sometimes it happens that suddenly you get a windfall from somewhere. Maybe you got a bonus, lump sum amount, and usually at this precise time you see some market fluctuation, like what happened last week. So his question was, let's say I have 10 lakh rupees lump sum amount which I can afford, which I don't need for next 4-5 years, which is qualified to go into an equity fund. But the moment you have a large sum, right, and then the moment you see that markets are not that large sum cannot be put. It's not really an SIP, right? Either you have to invest in one go, or another option is you mentally distribute it in SIP format and invest it over next 1 year or so. So his question was, what should an investor do when suddenly he's in this kind of situation where he has SIPs running but a lump sum amount sitting in form of cash, and he's confused what to do with it?
So in this, the SIP doesn't come into play. This also comes across as one box, and once you're clear on the box of instruction, it is scalable till infinity. The moment you come to know that the cash flow is coming, all you have to do is to align yourself and find the right liquid or liquid plus fund. The key part on this thing is that you have to have a corporate kind of a mindset. The money cannot be in the bank account for more than a day of what you're not going to use in that 1 month period. So whatever your expenses are running, consider this money doesn't exist. You have already done your planning, your SIPs are in place, you know what kind of expenses you operate on, and you have done your asset allocation on the equity and the debt side of the business. This new money comes in, it just doesn't remain. You have to create a current account kind of a thing for yourself, that no matter the money comes in, the money gets transferred on that very day to that liquid or liquid plus account, depending on what kind of time frame you're looking at. And in this case, you have already told that the time frame which I'm looking at is 4 to 5 years, right? So what was the earlier box saying? Anything which was above the 3 to 5 years moves into other stuff, and you can again follow your asset allocation piece. Basically, you have to understand that your cash flow is coming to you and you are following a certain asset allocation. This is an icing on that cake. It follows the same rule. 4 to 5 years moves into equity. Now what do? Money moves into the liquid fund. You're not thinking. You speak to your advisor, you go to your platform, and all you have to decide now is that where the money has to go. Yeah? Where does the money has to go? It has to go into the equity category because it's 4 to 5 years. You follow your asset allocation. Earlier, when you were doing your insurance planning, what you used to do, the word was called top up. You do nothing. It is top up. So there is, let's say you're running your SIPs in 3 or 4 schemes. You have chosen that. There's no need to reinvent the wheel. You've done it. Divide that by 4 and move ahead. Only difference here would be you have the money. There, it was on future money. So the nomenclature changes from SIP to STP. And that's it. Everything else remaining same. STP is nothing but for people who have the money now and they want to average it out during the course of time with a systematic transfer plan. Till the time the money gets transferred every month, every week, you choose the frequency, you earn the return of that liquid or liquid plus fund. So you don't leave the float to the bank. where you might be earning, let's say 3.5% return, which also is taxable post the cumulative amount crosses 10,000. We invest in bank big time because a lot of people leave the money and let the bank enjoy the flow. So these category of investors don't let the bank earn anything. I think what I could understand, you were opening a smart save account or something, right? Which works on the same premises. That the money is available to you, you're not letting it be there left in the bank. Now, all this, of course, is going to create a lot of pressure on the bank, but the kind of percentage exposure which an Indian citizen currently have in these kind of markets is so minuscule that for it to reach meaningful amount, banks, I think 2 or 3 generations would pass. But the basic idea was that it was a pass-through vehicle to reach equity. But you were generating return off of that as well. And plus, it was also guarding you from a perspective that you were not able to utilize it at your whims and fancies. You want, that was a different thing. But then there was a plan that money could just, in a scalable manner, move out and get invested without creating any hassles or headache for you that this is one more work to be done or I'm so busy.
Great. Thanks, Gunit. It was really a lot of good information, valuable information. I'm sure our viewers will find it very useful. And I would like to thank you again, Gunit, for taking out time and coming here and speaking to us. So that's all for today, folks. We'll see you in the next webinar.
Thanks so much.